Greetings, ladies and gentlemen. The archivist here. We must begin by dismantling a pervasive myth that is currently holding the fragile American middle class together. It is the persistent myth of fixed costs. For 3 consecutive generations, the absolute cornerstone of the American financial dream has been the 30-year fixed-rate mortgage. We are conditioned to believe that while the prices of bread, gasoline, and healthcare might fluctuate wildly, the fundamental cost of the roof over our heads is locked, stable, and entirely immune to the chaos of global markets. This belief serves as the psychological bedrock that allows people to sleep soundly at night. It is the primary reason why, even as inflation raged throughout 2024 and 2025, the average homeowner felt relatively secure. They believed they were insulated. But I am here to tell you that this security is a dangerous hallucination. The fixed cost era has officially ended. We have entered the era of the leverage ladder, and millions of Americans are currently standing on a rung that is about to snap. To truly understand the catastrophe that is scheduled for March 2026, we have to revisit the scene of the crime, the pandemic housing boom of 2020 and 2021. You remember it vividly. It was a period of absolute mass hysteria. The Federal Reserve aggressively took interest rates down to zero. The government flooded the economic system with stimulus checks. Suddenly, millions of Americans felt a primal, frantic urge to flee the cities, to buy space, and to acquire land. It was a buying panic unlike anything we have witnessed since 2006. But there was a structural problem. As home prices skyrocketed, up 20%, 30%, even 40% in places like Boise, Austin, and Tampa, the affordability mathematics simply broke. Even with record low rates, families could no longer qualify for the massive loan amounts needed to win bidding wars. So the banking industry, always eager to facilitate a transaction for a fee, dusted off an old product from the 2008 crisis bin. They didn't label them subprime this time around. Instead, they called them smart loan products. They called them adjustable rate mortgages, ARMs, and interest-only HELOCs, home equity lines of credit. The pitch was incredibly seductive. Why lock in a 3.5% rate on a 30-year loan, the broker would whisper, when you can secure a 5/1 ARM at only 2.2%? You'll sell the house or refinance long before the 5 years are up anyway. It's free money. It's how the wealthy trade. And they bought into it. Millions of prime borrowers, doctors, lawyers, engineers, people with 780 credit scores, took the bait. They used these temporary teaser rates to leverage themselves to the absolute hilt, buying homes at the mathematical peak of the market. They treated their homes not as essential shelter, but as high-leveraged bond portfolios. The Great Reset of 2026. Now, look closely at the calendar. If you took out a 5/1 ARM in January, February, or March of 2021, when exactly does your 5-year fixed period expire? It ends in January, February, and March of 2026. Right now, we are staring directly at the precipice of the Great Reset. This is not a mere prediction. This is contractual law. There is approximately $1.5 trillion to $2 trillion worth of residential debt that is scheduled to reprice in the next 6 months. And the gap between the original teaser rate and the current market rate is the widest it has been in 40 years. Let's run the forensic accounting on a typical success story family. Let's call them the Smiths. Imagine they bought a $700,000 home with a 5/1 ARM at 2.2%. Their principal and interest payment was roughly $2,600. In March 2026, that loan resets to the current market rate plus a margin. Suddenly, that 2.2% becomes 7.5% or 8%. Their monthly payment jumps from $2,600 to over $4,100 overnight. That is a $1,500 per month increase. Where exactly does that money come from? The Smiths don't have an extra $18,000 per year lying around. Inflation has already decimated their grocery budget. Student loans have restarted. Their credit cards are maxed out from the holidays. This is the payment shock. It is a silent killer because it doesn't immediately show up in the unemployment statistics. The Smiths remain employed. They look fine on paper, but mathematically, they are the walking dead. This calculation doesn't even include the HELOC trap. During the boom, millions of homeowners used home equity lines of credit to renovate their kitchens or install luxury pools. These loans often had interest-only periods for the first 10 years tied directly to the prime rate. In 2021, the prime rate was 3.25%. Today, that prime rate is 8.5%. The cost of servicing that kitchen renovation has nearly tripled. And unlike a standard mortgage, a HELOC can be called or frozen by the bank at any time if they detect financial weakness. This invisible reset creates a prisoner's dilemma for the middle class. Normally, if you couldn't afford the payment, you would simply sell the house. But here's the twist: the lock-in effect. The Smiths can't sell. Why? Because the value of their home has likely softened or stagnated, while the transaction costs, 6% realtor fees, and high closing costs remain elevated. But more importantly, where would they go? To buy a smaller, cheaper house, they would have to take out a new mortgage at 7.5%. Because prices are still historically high, the monthly payment on the downgrade house would be almost the same as the payment on their current luxury house. They are trapped. They are prisoners in their own living rooms. They will cut everything else to pay the mortgage. They will stop eating out. They will stop buying clothes. They will default on their credit cards and car loans. The housing market will suck the liquidity out of the entire consumer economy before the first foreclosure sign ever goes up. The institutional exit. We are looking at a silent depression mechanism. In 2008, the crisis was caused by subprime borrowers, people with no jobs and no assets. It was explosive and messy. In 2026, the crisis is being driven by prime borrowers, people with good jobs but toxic leverage. It will be slow, grinding, and it begins in earnest in March when the first massive tranche of 2021 vintage loans hits the reset button. The banks know this. The Federal Reserve knows this. Why do you think they have been discussing neutral rates and soft landings? They are trying to talk the market down before the mathematics of the reset triggers a default wave that the FDIC cannot possibly cover. But math is stubborn. The contracts are signed, the dates are fixed, and the Smiths are about to discover that their asset is actually a liability with an exploding fuse. If you want to know the absolute truth about the housing market, do not listen to the press releases from the National Association of Realtors. Do not listen to the forced optimism of the home builders. Listen instead to the silence of the whales. Listen to the entities that treat houses not as homes, but as lines on a spreadsheet. I am talking about the institutional landlords, the BlackRocks, the Invitation Homes, the American Homes for Rent, and the massive private equity firms that spent the last decade devouring the American single-family housing stock. For 10 years, specifically from 2012 to 2022, these entities were the bid of last resort. They put a floor under the market. They utilized cheap capital, money borrowed at near 0%, to buy 50,000 or 100,000 homes at a time. They created the renter society. They drove prices up because they were price insensitive. If a house yielded 4% in rent and their cost of capital was 2%, they bought it. It was an infinite money glitch. But in Q4 of 2025, the glitch was patched. The smart money has stopped buying, and worse, they have started selling. To understand why, you have to look at cap rate compression. The cap rate is the net return on investment from a property. Right now, after expenses, taxes, and maintenance, a typical single-family rental yields about 4.5% to 5%. In 2021, when Treasury bonds yielded 1%, a 5% return was gold. But in 2026, the risk-free rate, the yield on a U.S. Treasury bill, is hovering around 5% or 5.25%. Do the math. Why would a sophisticated Wall Street firm deal with leaky toilets, squatters, lawsuits, and property taxes to earn 5% when they can just park their billions in government bonds and earn 5.25% doing absolutely nothing? The risk premium for owning real estate has evaporated. In fact, it is negative. Every day they hold these houses, they are technically misallocating capital. My analysis of bulk deed transfer data across the Sunbelt, Phoenix, Atlanta, Charlotte, Tampa, shows a disturbing trend that the mainstream news is missing. The institutions are executing a distribution phase. They're not dumping 50,000 homes on the market all at once. That would crash the price and hurt their own book value. Instead, they're executing a slow bleed. They're offloading properties through shadow channels. They are selling directly to iBuyers or through private bulk sales to smaller, less sophisticated investor groups. They are listing homes on the MLS but making them look like individual sales. They are trimming the fat, selling the older homes, the homes in high insurance zones, and those with high maintenance costs. They are cashing out their equity at the peak, handing the bag to the retail buyer who thinks they are getting into the market. The credit crunch and regional bank failure. The institutional exit isn't just about cap rates. It is about the commercial real estate CRE contagion. We need to connect the dots between the empty office tower downtown and the suburban house. The banks that lend to these institutional landlords are the same regional banks that are currently drowning in bad commercial real estate loans. The regional banks are zombies. They are sitting on hundreds of billions of dollars of empty office buildings that are worth 40% less than they were 5 years ago. These banks are desperate for liquidity. They need cash to cover their reserve requirements. So they are calling in their lines of credit. They are telling the mid-sized real estate investors, "We are not renewing your warehouse line. Pay us back." This creates a forced selling event. The mid-sized investors, the guys who own 50 or 100 homes, don't have the cash to pay off the bank. So they must sell the houses. This brings inventory to the market not because of organic supply and demand, but because of financial distress. This is the credit crunch vector. Real estate runs on credit. It is the oxygen of the market. As we head into March 2026, the banking system is tightening the screws. Try to get a mortgage today. Look at the scrutiny. Look at the denial rates. The banks know what is coming. They know about the reset wave. They know about the insurance crisis. They are essentially redlining entire sectors of the economy to protect themselves. This removes the marginal buyer from the market. If the buyers can't get loans and the Wall Street giants are selling, who catches the falling knife? No one. The price has to drop to a level where cash buyers step in. And cash buyers do not pay 2024 prices. They demand a 30% discount. This is the hidden mechanism of the crash, the insurance death spiral. We have examined the borrower and the investor. Now we must examine the geography itself. Because in 2026, the greatest threat to your home equity is not the Federal Reserve, it is the actuary. We are witnessing the insurance death spiral, a systemic failure of the risk transfer markets that is rendering millions of homes effectively valueless. For 50 years, the American housing market relied on a hidden subsidy, cheap insurance. Regulators in states like Florida, California, and Louisiana politically suppressed insurance rates to keep voters happy. They prevented insurers from charging the real price of climate risk. This allowed development to explode in flood zones, fire zones, and hurricane corridors. But in 2024 and 2025, the dam broke. The reinsurance market, the global insurers like Lloyd's of London who insure the insurance companies, stopped playing the game. They looked at the data. They saw the convective storms in the Midwest, the intensified hurricanes in the Gulf, and the uncontainable wildfires in the West. They told the primary carriers, State Farm, Allstate, Farmers, to pay up or get out. The cost of reinsurance doubled. This forced the primary carriers to make a binary choice, insolvency or exodus. They chose exodus. In California, major insurers have simply stopped writing new policies. In Florida, the market is on life support, sustained only by Citizens, which is itself one hurricane away from bankruptcy. The crisis has metastasized beyond the coasts. We are now seeing premiums spike by 50% or even 100% in safe places like Ohio, Minnesota, and Colorado. Let's look at the mechanics of the death spiral. Say you're a retiree in Sarasota or a family in San Diego. Your insurance premium used to be $2,000. Your carrier leaves the state. The only quote you can find is $8,000. Or worse, you can't find a quote at all. If you have a mortgage, this triggers force-placed insurance. The mortgage contract states you must maintain coverage. If you don't, the bank buys a policy for you. They don't shop around. They have a prearranged deal with a high-risk insurer. The cost of force-placed insurance is typically 3x to 4x the market rate. That $2,000 premium could jump to $15,000 or $20,000 a year. That is an extra $1,500 per month tacked onto the mortgage. The borrower defaults. When the bank forecloses, they try to sell the house. But who buys it? A new buyer also needs insurance to get a mortgage. If the house is uninsurable or prohibitively expensive to insure, it is unfinanceable. A house that cannot be financed is a toxic asset. It effectively has a value of zero to anyone who needs a loan. The only potential buyers are cash vultures. They will offer 50 cents on the dollar. This crashes the comps for the entire neighborhood. If one house sells for a 50% discount because of insurance, every house on the block loses equity instantly. This leads to strategic defaults where people realize they owe $500,000 on a house now worth $300,000. They mail the keys to the bank. You cannot stimulate your way out of this. The Fed can print money, but it cannot print a lower probability of a hurricane. The risk is physical. The cost is mathematical. The Archivist Shelter Protocol. We have analyzed the 3 pillars of the coming collapse: the mortgage reset, the institutional exit, and the insurance death spiral. The evidence leads to a singular, inescapable conclusion. The American housing market is currently a value trap. Buying a home in this environment is akin to catching a falling knife while standing on a landmine. You are locking yourself into an exploding liability structure. So, how do you navigate the leverage ladder without falling? You need to adopt the Archivist Shelter Protocol. Protocol Rule 1, the strategic exit. If you are currently a homeowner sitting on significant equity but your cash flow is constrained, sell now. Do not wait for the spring selling season. The inventory spike is coming. Once the force-placed insurance letters hit and the arm resets bite, the market will be flooded with desperate sellers. You want to be the first one out the door, not the one trapped in the burning theater. Convert the equity to liquid capital. Park that capital in short-term U.S. Treasury bills, T-bills. You are trading in a liquid, depreciating, expensive asset for a liquid income-generating asset. In a deflationary credit crunch, cash is king. The person holding cash in 2027 will be the master of the market. Protocol Rule 2. Neutralize variable risk. If you cannot sell, you must audit your debt immediately. If you have an ARM or a HELOC, you are in the kill zone. You must neutralize this risk before the reset. If you can refinance to a fixed rate, even at 7%, do it for the certainty. If you cannot refinance, you must aggressively pay down the principal on the variable portion of your debt. Every dollar paid down on an 8.5% HELOC is a guaranteed, risk-free 8.5% return. Deleveraging is the highest form of investment in 2026. Protocol Rule 3, the renting advantage. If you are a prospective buyer, wait. Renting is currently 50% cheaper than buying in almost every major metropolitan area. Let the landlord deal with the insurance death spiral and the property taxes. Maintain your mobility and your liquidity. Protocol Rule 4, the vulture stance. The goal is not just survival, it is acquisition. But you must acquire at the right time. The time to buy is when the banks are overwhelmed with inventory they cannot clear, and institutional landlords are liquidating entire blocks of homes for pennies on the dollar. This window opens in late 2026 or 2027. Prepare now. Build your cash pile. Watch the neighborhoods. Wait for the blood in the streets. The leverage ladder was built on the arrogance of cheap money. It seduced millions into believing debt was wealth. But the bill is coming due. March 2026 marks the beginning of the great unwind. Secure your shelter, liquidate your leverage, and wait for the reset. This is Archivist. The protocol is active. Class dismissed.